Office vacancy in the Philippines is quietly rising again. And for investors, this is not something you can ignore. Because when offices empty out, rents go down. When rents go down, earnings drop. And when earnings drop, your dividends are next. Today, we're going to talk about why this is happening, why the numbers don't match the hype, and most importantly, which REITs are surprisingly holding the line despite everything collapsing around them. And trust me, you need to stay until the end because I'm going to reveal a data point barely talked about that could completely change how you invest in REITs next year. Let's dive in. You've heard it before. Return to office is happening. Corporate demand is coming back. Economic recovery is in full swing. But the data, the actual numbers, they tell a very different story. Depending on the source, Metro Manila office vacancy is floating anywhere between 19% to 22%. That means nearly 1 out of every 5 offices is empty. In some business districts, it's even worse. And here's the part nobody wants to say out loud. The Philippines built too many offices, companies downsized, and hybrid work is not going away. This is the painful truth. We are sitting on one of the highest vacancy rates in Southeast Asia. Singapore, lower. Vietnam, lower. Even Indonesia, with all its volatility, is not dealing with this level of oversupply. Yet, back home, we pretend everything is fine. Here's the hard part. Vacancy is not just about companies leaving. It's about companies not arriving. Foreign investors, slower. BPO expansions, cautious. Startups and tech, most have downsized. So even if some companies return to the office, the pipeline of new tenants isn't strong enough to absorb the massive supply that keeps hitting the market. And let's be honest, if demand is weak and supply keeps expanding, who takes the hit? Not the developers, they already built their towers. Not the POGO operators, they're gone. You guessed it, the hit lands on REIT shareholders. Let me break it down simply. High vacancy, lower occupancy, rents drop, lower REIT earnings, lower dividends. Dividends are not magic, they come from rental income. And rental income comes from tenants. No tenants, no rent, no earnings, no dividends. Some REITs are still paying well now only because they locked in long-term leases years ago. But when those leases renew, are you 100% sure the tenants will stay? Are you sure they will stay at the same rent? Because I'm not. And smart investors shouldn't be either. Some REITs are more exposed than others. Office-heavy REITs are taking the brunt. If your REIT depends heavily on traditional office tenants, law firms, consulting, small BPOs, prepare for turbulence. Certain districts are facing longer leasing cycles, more aggressive rent discounts, higher tenant turnover. In some locations, landlords are practically begging tenants to stay. There are even stories off record of buildings offering months of free rent just to fill space. If you're a REIT investor, your dividends may look stable today, but the pressure is building underneath. This is the pain the market hasn't priced in yet. Now, here's where things get interesting. Not all REITs are collapsing. Some REITs, surprisingly, are adapting well. They have better tenant quality, longer contract durations, exposure to logistics, industrial, or data centers, more diversified revenue streams, properties in locations where real demand still exists. These REITs are not immune, but they are far more resilient. And yes, in a slowdown, these REITs become the lifeboats for the average investor. They prove one thing: even in a property downturn, quality still wins. If a REIT has high-quality anchors, long WALE, minimal dependence on weak office districts, and strong management teams, it can not only survive, it can actually come out stronger. If you're watching this, here's what you should be doing. Stop chasing yield blindly. 6.5%, 7%, 7.5% means nothing if the asset base is decaying. Check exposure to weak office districts. Some areas are in structural decline. Evaluate tonomics. If the tenant list is fragile, the REIT is fragile. Look for REITs with non-office assets. Industrial parks, logistics hubs, data center shells, these will outperform over the next decade. The market rewards patience, but it also punishes ignorance. Now, here's the part I told you to wait for. There's one number that should terrify every REIT investor. Of all the new office supply coming online in the next 12 to 18 months, over 60% does not have confirmed tenants yet. That means vacancy will rise before it gets better. But, and here's the opportunity, when everyone is panicking, that's when the best REITs finally go on sale. I'll be releasing a follow-up video ranking the 5 strongest REITs that can survive a property downturn. So make sure you're subscribed. Because if you get this right, you won't just protect your money, you'll position yourself for the rebound that nobody else sees coming. Before you buy or sell, buy time. Study first. Headlines react. Good decisions. Research. Slow down. Get deliberate. Here's a simple 5-point study plan. 1. Know your goal, risk tolerance, income growth, or both. 2. Read the latest REIT report. Check occupancy whale, lease expiries, tenant concentration. 3. Stress test cash flows. Vacancy up 5 to 10%. Rents down 5 to 10%. Rates up 100 bits per second. 4. Inspect the balance sheet. Debt, maturity ladder, interest cover, refinancing risk. 5. Compare price to value. NAV discount, NAV premium. Dividends, sustainable at the payout. Build process habits. Keep a watch list sheet. Update quarterly. Skim earnings calls and disclosures. Log red flags. Mark green shoots. Track sector indicators. New supply take-up, pre-leasing net absorption. Use a decision journal. Write why you buy key risks. Exit plan, time rules. If unsure, wait 7 days. Let the noise settle. Start small. Add only when new data confirms. Mindset, missing a trade is fine. Avoiding a bad one is better. Study buys you clarity, and clarity protects capital. Study first, then decide. Subscribe for deeper breakdowns. Quick recap, vacancies are high rents, under pressure, quality still wins. Protect your capital, tenant quality, whale strength, diversified assets. Stress test assumptions, vacancy up 5 to 10 rents, down 5 to 10 rates, up 1%. If numbers don't hold, wait. Patience beats panic. Build your checklist: occupancy, expiries, tenant concentration, balance sheet valuation. Then decide with intention, small positions first, add only on confirmed data. I'm ranking the 5 strongest REITs next, don't miss it. Subscribe, comment your top REIT pick, and share this with a friend. See you in the next deep dive.